You and I have no control over the movements in the stock or the bond markets or interest rate or various things regarding the economy. But the good news is, from which account you take income and when, you and I have complete control over this. And this includes from which account you give to charity. So if you give to charity from your bank account, there's a good chance you aren't getting any income tax benefit. But if you meet certain qualifications and give directly from your IRA, it will help on your income taxes. So I'm Oliver Kolofsky, Director of Wealth Services and Wealth Advisor at Sweet Financial Partners located in Fairmont and Jackson, Minnesota. We specialize in working with high net worth people who are at or nearing retirement. And we believe that everyone has the right to realize that their dreams are possible and use that as the focus when working with you and helping you plan for your future. So money can really only go three places. One, it can go to the IRS in the form of taxes. It can go to charity, or it can go to people, one or many number of people. So that sometimes maybe, it gets overcomplicated as to where money's going and when, but to simplify things, we also want to think that, it's really going to go in the form of taxes, charity, or people. Those are really only the three places money can go. So sometimes you can choose how to allocate amongst the three. And today you'll learn how to get more to charity, which in turn would mean less in taxes, ideally. So this video, it would be ideal for these folks here. So as I outline it, if you fall in these categories, it's ideal for you. One, this is about charitable giving, how to tax efficiently give to charity. So if you want to be charitably inclined. Number two, you and your spouse are over age 70 and a half, or will soon be over age 70 and a half. And one of the things we'll want to emphasize here or clarify is that in order to do the strategy we're going to talk about, you actually have to be 70 and a half, not the year in which you turn 70 and a half, but you actually have to be 70 and a half when you do this. But if you're close to that age, this video is still going to be very valuable for you. Number three, you have to have a traditional IRA to do this. And what we're talking about here is a qualified charitable distribution. Lots of acronyms here in the investing, in the financial planning world. This would be QCD, qualified charitable distribution, QCD. That's the strategy we're going to be talking about. So in order to do this, you have to be charitably inclined. You technically have to be age 70 and a half, and you have to have an IRA. It's a traditional IRA. So it wouldn't make sense to do this strategy from a Roth IRA. Roth IRAs are already tax-free forever if you meet certain qualifications. So it wouldn't make sense. It also, again, you have to have a traditional IRA, which is pre-tax. So you might have like a 401k from a prior job or your current job, or a 403b. I mean, those can also be pre-tax as well. But in order to do the qualified charitable distribution or QCD strategy, it actually has to be an IRA. So the good news is if you have a 401k or a 403b from an old job and you want to take advantage of this strategy, you can do a rollover to an IRA and then do the strategy, do the QCD or qualified charitable distribution. So there's a maximum a person could do. Maximum amount you can give to charity through the QCD or qualified charitable distribution strategy each year. It's $100,000. And with the passage of the Secure Act 2.0, some government legislation, federal government. They passed the Secure Act 2.0 at the end of 2022. This $100,000 will now index upwards for inflation in future years. It had been at like a level $100,000 for some time. Now it will move upwards with inflation. So the QCD, let's go through what exactly it is, and then later in the video we're going to go through how to do it correctly, or things to keep in mind to do it correctly. So what you're doing here, if you're giving cash from your bank account, probably not getting a charitable deduction because you likely take the standard deduction. Most people do, not all, but most. Meaning you get to so everyone gets a standard deduction for married filing jointly. Let's say it's over $30,000 in 2023 if you're over age 65. So you'd have to have what are called itemized deductions, which would be like certain state and local taxes up to a limit, medical expenses, charitable giving, any mortgage interest, all that would have to add up to more than $30,000 for you to get a tax benefit for giving cash to a charity. That's for married folks. Same concept applies. The numbers are slightly different for single folks. So with the QCD or qualified charitable distribution strategy, you take money from an IRA and it goes directly to charity. It doesn't make a pit stop at your bank account. The money goes directly from your IRA to charity. That money does not, that amount that you gave to charity from your IRA does not get put on your tax return as ordinary income. Yep. So since it never is on your tax return as ordinary income, the net effect is, in essence, it's been fully deducted. If you're age 73 and have a required minimum distribution or RMD, more on this after a bit, if it's done correctly, this can count towards the RMD or required minimum distribution. So how this helps you is you're getting a tax benefit. You're lowering your taxes while giving the same amount to charity. And maybe you take the tax savings and you give more to charity. So it also helps with, since, as I mentioned, it's never counted as income. So if you did a $10,000 QCD, qualified charitable distribution, so you move $10,000 from your IRA to a charity, it's never counted as income. It can help with what are called stealth taxes, which would be the more greater income you have, the more Social Security that's subject to tax. Well, if your income is lower, maybe less of your Social Security is subject to tax. The IRMA surcharges, if your income's over a certain amount, your Medicare costs more. Well, if you never have to put that income on your tax return, maybe it helps those types of taxes. So let's go through how to do it correctly, how to do the QCD or qualified charitable distribution correctly. We touched on these earlier, but I'm going to go through it in a little more detail now. So number one, the money must go directly from your IRA. So the custodian, which is where your IRA is held, like Schwab or Fidelity, they would end up making a check out to charity. So there'd be a check made payable from your IRA to charity. So what's key is that the money doesn't first get deposited into your personal bank account. If it first gets deposited in your personal bank account, it means it's done wrong. You're not going to get the tax benefit. The other thing, and I mentioned it or foreshadowed a few moments ago, it can count towards your required minimum distribution, your RMD. And again, RMDs for people like turning 73 this year starts at age 73. That's when RMD started. If you're a bit older than that, you might have had your RMD start at age 72, or if you're even a bit older than that, you may have had your RMD start at age 70 and a half. Anyway, for the purpose of this video, let's say RMD start at 73. The QCD can qualify or can count towards your RMD if done correctly. Let's say your RMD is $15,000 for a year, for a given year, $15,000, and you want to do $5,000 QCD, which then the ideal outcome would be $10,000 of your RMD would actually be subject to taxes, the other $5,000 wouldn't. But if you first take the $15,000 distribution to your bank account and then move $5,000 directly to charity, it would have been done wrong. The $15,000 is what you would have to put on your tax return. So if you take the RMD first and move it to your bank account, first money out of an IRA is considered RMD, required minimum distribution money. If you're going to do QCD, you want to take your QCD, qualified charitable distribution, do those before your RMD is fully satisfied, such that your QCD qualifies towards your RMD. So most people think it's done now. Let's say you gave money from your IRA to charity. The charity has the money. It came from your IRA. It's done. But there's actually another step. One more step to do a QCD correctly. So it has to be accounted for correctly on your income tax return. So for the 2023 tax year, this year, you or your tax preparer would have to put your total IRA distributions on line 4A. It's on your tax return, your federal tax return, and then put the taxable amount on line 4B. And if you had done a QCD, then line 4A and 4B wouldn't be the same figures. So in the example we just went through moments ago, if someone had a $15,000 IRA distribution, $5,000 of which was a QCD. Line 4A, the total distribution amount would be $15,000. Line 4B, taxable amount, going to be 10,000. 5,000 went to charity. Then also there's a dotted line by 4B. You'd want to note the letters QCD would need to be noted on the tax return. So great tax benefit for those folks age 70 and a half or over, charitably inclined, have an IRA. Great thing, just have to do it properly to get you the tax benefit. So one of my colleagues here at Sweet Financial, Amber Knips, she did a video earlier called 8 Questions Every Couple Should Ask Before Retirement. It's a nice tie into this topic. We received a lot of positive feedback on it. I'll include the link here. And as always, you can email me directly at oliver@sweetfinancial.com. Again, oliver@sweetfinancial.com to email me directly. Have a wonderful day.